Hello investors, welcome to Simpli Stocks. I have around 15 businesses on my watch list in the microcap space that are currently performing quite well. In my previous video, I covered 5 such undervalued microcap or penny businesses that have announced very good results. I will provide the link for that video in the description for you. If you have not watched that video, you can go and watch it after watching this video. Many people like that video. That is why we have brought the second part of it, in which today we will talk about 5 new microcap companies that have delivered very good results. These are all high growth models, but since they are very small in size, the volatility and risk will be higher here. You need to keep that in mind. And yes, as a standard disclaimer, this is not a buy or sell recommendation for any stock. Our motive here is solely to help you understand their business models so that you can study them yourself. With that being said, let's get started. The first business we will study is Womankart. Womankart is a very small company. You will see its market cap is just 200 CR. Here you can also see its PE ratio. This business is currently trading at a PE of 23 to 24. You can think of Womankart as similar to Nykaa. This is a woman-focused platform and they sell makeup, skincare, hair care, jewelry, perfumes, personal care, footwear, and clothing products from their website and offline stores. In addition to the website, they also have 8 offline stores in Delhi NCR. Womankart sells products under its own brands. They have built a strong portfolio of 8 brands across different categories. And besides that, like other platforms, they also sell products of other brands. For example, on their website or in their stores, you will find products from many famous brands like Sugar, Minimalist, Cetaphil, Olay, Color Bar, and Body Shop. Category wise, approximately 65% of their sales come through other brands and 35% of sales contribution is from their own brands. The advantage of keeping your own brands is that your margins tend to be higher here. And product wise, fragrances is their largest product segment. 25% of their sales come from here. Makeup and skin and hair care products contribute approximately 15% each, and they launched a new segment, crockery, 2 years ago, which has grown to have a 18 to 20% contribution in their business, and clothing is currently around 10 to 11%. Womankart is Delhi focused. All their stores are in Delhi. They are following a focused strategy, which is quite good actually, because as a small company, you cannot build a nationwide distribution network and marketing presence. And even if you do, by burning cash in the name of growth, you won't be able to manage it. Womankart has a very good strategy of profitability-led growth. That means growth should be there, but profitability should not be compromised in the process. In this direction, you will see in H1 or in the months from April to September, their sales have grown 127% from last year, and EBITDA has also grown by 37%. This is a very good top line growth because the management had given an estimate of around 50% sales growth only. And you are seeing here that sales growth is more than double the guidance. Net profit growth was 69%. It would have been better if growth was even higher, but the company is spending on expansion, opening new stores. In such a situation, lower profit growth is also acceptable. But you will see their EPS has grown by only 33%. This is a red flag in Womankart that you need to be aware of. What has happened is that Womankart has been raising funding repeatedly for expansion. Because of this, their promoter shareholding has diluted and reduced, and simultaneously, the EPS has also diluted. In such a case, even if profit growth is coming, there is no EPS growth. The market does not like it. Another risk you need to keep in mind is that this is a very small business and investor communication is very low. They only release investor presentations. They do not hold conference calls with investors. In such a situation, you only have the results and investor presentations to find out in which direction the business is heading. That too once in every 6 months. It is not that they announce results every 3 months. And yes, lastly, you might find the business model weak compared to Nykaa. However, Womankart can be a good distribution-led business in the short term. The more they expand distribution, the more their top line and bottom line will grow. That is why you can study this business yourself once. The growth is strong here, and at the same time, the valuation is also good. The second microcap business on our list is Tembo Global Industries. We covered it 2 months ago as well, And here in our Simpli Stocks community, we have been tracking it for quite some time now. The company has been in low margin textile business so far, but now it is entering the engineering products, defense and solar sectors. Because of this, on one hand, sales growth is strong for Tembo, and at the same time, due to the change in product portfolio, the margins are also expanding. So the bottom line growth is even better. Until last year, 60% of their sales came from textiles and remaining 40% from engineering products. But here you will see that this is rapidly changing. In Q2, both divisions had approximately 50-50% share. And in the coming quarters, the contribution of engineering products to the business will be increasing further. So where 60% of their sales came from textiles last year, their guidance is that the contribution of this segment will come down to just 30% this year. For their textiles business, they process fabrics, fibers, yarn, and then supply them to brands, retailers, chain stores, etc. Talking about engineering products, which is their emerging segment and trigger for this stock, in this business, they manufacture such clamps used in shipbuilding, industrial machinery, large vehicles, and refineries, etc. These clamps are used to hold pipes, machinery, etc. They have a manufacturing capacity of 18,000 metric tons for these engineering products. Besides this, you will see below, they are entering into two product segments, ERW pipes with 60,000 tons capacity and strut channels with 30,000 metric tons capacity. ERW pipes are used in oil and gas and water and sewage management. Strut channels are used in construction, electrical and plumbing works. This expansion is also very well planned because they already supply clamps for oil and gas, storage tanks and electrical segments, and they will be manufacturing ERW pipes and strut channels for these very sectors. Their new capacity will start in Q4, that is from the months of January to March. There is a slight delay in this. Earlier, their management was saying that this new capacity would start from Q2 itself. Overall, their total manufacturing capacity will increase from 18,000 tons straight to 105,000 tons. Apart from textiles and engineering products, Tembo also provides EPC services. In this, they undertake construction work for things like fuel farms and marine jetties. You can understand a fuel farm as an oil pump for ships and airplanes, etc. Ships and boats dock at a marine jetty. So Tembo also takes up such EPC projects. This is also part of their engineering solution segment. Now let us look at their results. Tembo's management had given a sales target of 1100 crore for this year, which amounts to 48 to 50% sales growth over the last year. In the 6 months alone, from April to September, they have already achieved 494 crore in sales, or 45% of the guidance. So in my opinion, they will be able to easily achieve their 50% sales growth target. Looking at Q2 performance, meaning the months from July to September, their sales have grown well by 50% from last year. There has been a good margin expansion too. The EBITDA margin has increased from 9% to 13.5%, and net profit has grown 51% from last year to 22 CR this quarter. So these are very good results for Tembo, and even after the recent rally, this business is trading at a very good valuation. If you go and check, Screener is currently showing Tembo's PE at 17 and 18 only. And you see, the capacity for engineering products is not even there yet. When the plant starts, we will see further growth and margin expansion. Now, if I summarize through this screenshot, Tembo is currently in these two businesses, engineering solutions and textiles, and in the future they will be entering solar and defense manufacturing also. Currently, half of their sales come from textiles and the other half from engineering products, but their estimate is that from next year, 60% of their sales will come from the engineering division, 10% from textiles, and remaining 20% share will be from defense and 10% from solar power. And right here you can see that their EBIT margin in the textile segment is just 2% approx, while it is 17.5% in engineering solutions. So as this transition from low margin to high margin business happens, we will also see good expansion in the bottom line or net profit. They are also making good progress on their expansion plans. Like 40 to 50% of their machinery has been installed so far. Similarly, for the solar business, they have acquired the land and talks are currently underway with IREDA for 470 CR loan. Separately, they have been allocated 100 acres of land by Maharashtra government for the defense plant. and they are currently waiting for that subsidy. Now, before we move on to the third stock, a humble request. If you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Let us come back to our discussion. The third business we will study is HOAC Foods. As you can see on my screen, this company is in the business of processing and selling kitchen essentials like flour, spices, pulses, rice, oil, etc. Their brand name is Hariom. Hariom primarily used to be in the flour business, but they have diversified into spices, oil, and so on over time. Here you will see that they have been adding new SKUs consistently. SKUs is basically the total number of different products you sell under different quantities. Hariom's USP is that they are targeting a slightly premium segment, and they are focusing on freshly milled flour. The packaged flour available from other brands in the market is old, whereas their flour is freshly grounded. Additionally, you will notice a trend that people nowadays are customizing their flour by having pulses, grains like ragi, jowar or bajra milled along with it. For this, all their stores have machinery that allows you to customize your flour according to your preference. The company purchases all these items from farmers and dealers and then processes and packages them in its two plants. HOAC is based in Delhi NCR. Approximately 45 to 50% of their sales come from flour, 11 to 12% from spices, and 9 to 10% from oil. The remaining 30% contribution is from other products. Similarly, channel-wise, 54% of their sales come from their own stores and app, 37% sales come from other stores, and furthermore, they also supply flour to famous company Country Delight. Both these together constitute their B2B segment, and approximately 8% of their sales are now coming from exports, with the UK and US currently being their target markets. Hariom has delivered very strong results. Sales in H1 have grown by 97% over last year to 22 crore. In the same direction, you will see that their EBITDA and net profit have also doubled compared to last year. Their sales target for this year was approximately 55 CR in sales, and they have already achieved 22 CR in the first 6 months. Therefore, HOAC will easily meet its target. You can see how fast the company is expanding. Last full year sales were 27 CR, and they have already achieved 22 CR in the first 6 months of this financial year. So based on 55 CR sales target, their goal for this year is to double their sales. Then in the next year, meaning FY27, they will be targeting 75 to 80% sales growth. So we can say that we have a good visibility for future growth at HOAC too. And for this, they are also expanding their capacity. HOAC right now has two plants in Gurgaon across 12,000 square feet area, where they currently are operating at 80 to 85% capacity utilization. And they are now setting up a third unit of 50,000 square feet area in Vidisha of Madhya Pradesh, which will go live in phases. In the first phase, the facility will start in 20,000 square foot area within 2.5 to 3 months, and at full potential, this Vidisha plant can easily generate more than 100 CR in sales. This means with the opening of this Vidisha plant, their capacity will triple. This is a very significant expansion. Vidisha is near Bhopal, and with this plant becoming operational, they will be entering the South Indian market. For this, they have also raised 10 CR in funding from institutional investors in the month of July. When this fundraise happened, we also did a detailed analysis of HOAC for our community members. Because you see, when such a fundraise occurs in such a small business, it gives a lot of confidence to retail investors, as these institutions invest only after thorough due diligence. This concludes the discussion on their manufacturing base. And on the distribution side, there also the management is working very aggressively. They now have 19 stores in Delhi NCR, and their target will be to open 10 to 11 stores every year. This is their B2C segment. And to grow their B2B business, they are changing their model to focus on distributors. Previously, they dealt directly with retail stores, but now they are moving to a distributor-led model, where each distributor will manage 250 to 300 retail stores. By doing this, they will increase their B2B network from 1,400 stores to 5,000 stores by the end of next year. So this is also a very big step that will drive sales growth in the future. HOAC has rallied quite a bit recently. Therefore, let us quickly do a valuation of this business. So, as I told you, they are targeting approximately 100% growth across every metric for this year. Their goal for this year is 55 CR in sales, and they will be earning a net profit margin of around 9 to 10%. In this scenario, even though screener might show you a higher PE, the forward PE of HOAC based on the estimated profit for this year comes out to around 30. Considering microcaps, yes, this is a slightly premium valuation, but you are getting a branded player along with very good growth here. Their Vidisha plant is a big trigger going forward, so you can independently study HOAC yourself once. The fourth microcap business on our list is Thomas Scott. Thomas Scott is also a portfolio stock of Shankar Sharma and Ashish Hajolia. As you can see in the shareholding pattern here, that Shankar Sharma has 8.3% stake and Ashish Kacholia has about 2.1% stake in Thomas Scott. Thomas Scott is a textile stock, meaning they are in the business of making clothes. But this is a very unique business model. For example, if you look at other companies like Wellspun Living, Bella Casa or Himmat Singha Seed, they are pure play in contract manufacturing. When another brand places an order, they simply manufacture and supply the clothes or textiles to that brand. The margins there are very low, but Thomas Scott's business model is quite different. If we look at their business model, they have three segments: their own brand, Thomas Scott; licensed brands, where they manufacture and sell clothes for other brands on a license basis; and third is pure play contract manufacturing, where they make clothes on a contract basis for other famous brands like Raymond, Lady Tape, and Being Human. This contract manufacturing is a very small segment for them. Only 5% of their sales come from here, which is actually a good thing because margins are very low in contract manufacturing. We will focus more on understanding their other two business segments. So the first segment here is their own brand. They sell clothes online under their Thomas Scott brand on Flipkart, Ajio, Myntra, and Amazon. Thomas Scott is a menswear brand. Additionally, they also have 5 stores in Bangalore. Around 45% of their sales come from here. Their second segment, licensed brands, is actually a very interesting segment. In this, they have partnered with Myntra, Ajio, etc., and they manufacture and sell clothes for their brands on a license basis. This means they manage everything from designing and raw material sourcing to manufacturing of clothes and then listing and selling those clothes themselves on these platforms or apps. They manage the entire end-to-end work. For example, as you can see here, they manage brands like Marston Harbour, Invictus, Aeropostale, FC UK, and Nautica for Myntra on a license basis. 60% of their sales come from this licensed brand segment, and this is the most interesting segment in this business. Thomas Scott has done a lot of work on automation and AI too. They have deployed two AI models, Thread AI and Catalog AI, which help them significantly in identifying fashion trends on e-commerce, deciding on pricing, managing the catalog, and managing listings. In all these aspects, they have a network of 4 manufacturing units and 4 fulfillment centers or warehouses. And as you can see in this photo, how strategically they are located near major demand hubs: Delhi NCR, Mumbai, Bangalore, and Kolkata. They have a manufacturing capacity to produce 60,000 shirts, 60,000 pants, and 20,000 bags every month. Now, let us talk about the business performance. You will notice how at one point B2B contract manufacturing used to be their biggest business segment, but its share in their business has been decreasing, and they have been growing their own Thomas Scott brand and licensed brands. Roughly 84% of their sales come from menswear, 7% are from kidswear, and the remaining approximately 10% contribution is from women's wear, women's accessories, and men's accessories. Thomas Scott's results have also been very good. Their sales have grown by 40% over last year. There has been a very good improvement in margins too. You will see that their EBITDA margin has increased by more than 400 BPS or 4% to become 14.9% or almost 15%. Because of this, profit growth has also been very good. Their net profit has grown by 68% over last year to 5 CR. Looking at half-yearly results, the company has achieved 111 CR in sales and a net profit of 8 CR in the first 6 months of the year. Compared to previous quarters, there is a slight slowdown in Thomas Scott. The reason for this is that customers postponed their purchases due to the GST rate cut. Everyone knew that things would get cheaper after the GST cut. As a result, purchasing came to a halt. But despite that, this 40% sales growth is a very good performance, especially when you see that no other player in the industry is able to increase their sales. All the exporters are affected because of the Trump tariffs, and domestic players are unable to grow their business for one reason or another. As for the valuation of Thomas Scott, it might seem slightly premium to you, but you should not look at it like any other contract manufacturer in the textile sector. Their margins are very strong and their business model is also quite unique. The management does not give any guidance, but still let us roughly do a quick valuation exercise. Since they have achieved 111 CR in sales in the first 6 months of the year, in my understanding, they will easily achieve at least 225 CR in sales for the entire year. Currently, their PAT margin is at 7.4%. The management said that Q2 margin was slightly higher because customers were comfortable buying slightly more expensive clothes due to the GST rate cut. They felt that things were cheaper anyway because of the GST cut. Therefore, if we take a 7% net profit margin average for the whole year, Thomas Scott will conservatively achieve a net profit of around 16 CR for this year. The current market cap of this company is around 600 CR, on which your forward PE comes out to around 35. So this is a very good valuation for a business that is growing so fast and has a unique business model. Thomas Scott is a good proxy business for e-commerce growth in India, which you can study yourself once. Another microcap business that has shown very good results in Q2 is SKM Eggs. SKM is benefiting from the flu that has occurred in USA and Europe. In the short term, this can be a good business. Just 2 weeks ago, we analyzed SKM's Q2 results in another video. Therefore, we will not do it again. I will include the link in the description along with the video timestamp. Please make sure to watch it from there. Lastly, if you like this video, do give me a thumbs up. You can also subscribe to our channel Simpli Stocks. All these micro caps are very special but hidden stocks. It takes a lot of time and effort to research all this and study them. If you support us through your likes and subscriptions, we will be able to bring more such videos for you. I will see you in the next video. Happy investing.